I'm Bob Maynard, and I've been a Chief Investment Officer at the Idaho Retirement System for quite some time. And I've been in this business since the mid-'80s, basically, 4 different decades. So I'm getting to the curmudgeon age as it goes forward. And one of the things that's interesting right now is I don't think in the times I've been around the business that I've seen as much confusion on my side of the industry as to how to go about putting together an investment program, a portfolio of investments. It's getting to the point now, particularly after the first worst market since the Great Depression in early 2000s, the tech wreck, and then the second time of the worst market since the Great Depression. There's been kind of a crisis of confidence, or a spreading like a dandelion going to seed of new ways to look at investing, new ways of trying to put portfolios together, from risk sleeves to risk budgeting, anything with risk in it, risk parity, which is basically leverage, to entire new asset types and classes and investment vehicles. Which is fine. That happens a lot in investing over the decades. But what is starting to disturb a number of us is that you're starting to hear people say, these just aren't new ways of doing things, that you have to do it, because the old way of going about putting a portfolio together, the old way of looking at what I call conventional investing, has proven to be false. It just didn't work. It fell apart. And what bothers me is it's not true. It's simply not true. The conventional investing still works according to the way everybody thought it would. It still is the best way to found the base of a portfolio. And that's what this particular presentation is about, is even though it is a complex world and that there's the proliferation of ways to do things that's just gone crazy, that's still a good basic conventional approach for the majority of people and majority of situation still is perfectly fine, and for many of us argue that it's better than the alternatives. So what I'm going to go over is some examples and an overview of the conventional approach. It's basically a simple, you're transparent, you're focused, and you tend to have to be very patient. I'll give some contrast between conventional investing and complex investing, particularly what's been called the endowment model, and try to demonstrate that usually more investing leads to less response or less returns. And there's something I like to call the Swenson J curve that I'd like to go over on that. Then I'll go back through and basically review for all of you who want to be reminded of what you got in Finance 101, some of the basic tenets of conventional investing. And then why there's been this move to the alternatives, challenges of that particular approach. And then that there was a complex response that came in, basically the endowment model, most famously explicated by David Swenson, but followed by 90% of the industry in the mid-2000s, and why that failed. And by the way, I will either go over the endowment collapse or the hedge fund. That's the accordion portion of the presentation. As we get closer to 45 minutes, you will see me either talk a lot faster, or you will see about one of those two dropped. Now, what are the basic tenets of conventional investing? Well, pretty much what you remember. It's public equity oriented, 60 to 70% public equities, 30 to 40% fixed. Why is that, by the way? Because most people's needs for liabilities are somewhere in the nature of 3.5 to 5% above inflation, 3.5 to 5% real. And so as a result, if you historically, since the 1800s, are getting 5 to 7% above inflation with equities and 1 to 2% above inflation with fixed income, a 60 to 70% equity exposure gives you 3.5 to 5% real over rolling 20-year periods. People keep saying that everybody in my industry are lemmings because we follow that thing. No, it's because our liabilities are such. My liabilities at the PERSI fund are 3.75% real. If I make that, I'm very happy. 70% equities. If 70% equities doesn't get me 3.75% real over a rolling 20-year period, the condition of the state of the earth has been a comet's hit it. Who cares about the pension fund then? Second, it's broadly diversified. You have 5 to 7 major asset types. Those are them: U.S. equities, the international developed market. REITs and TIPS are the ones that came in the last 15 years. But in particular, you don't over-diversify. The benefits of diversification basically disappear after the 5th or 6th asset class, and in some of them they disappear in 4. You aim for market returns. You don't rely on active management for the success or failure of the program. There's nothing against using active management, but you shouldn't depend on it to success. And if you're going to do it with a long-term time frame in mind. And you need a 5 to 7 year time frame for this to work out. You need to be patient. It doesn't work in each and every year. Now, this is a tradition. This is not something that came out, and it still is a tradition that has been advocated by a number of people in our industry. And here are some of the examples of people that are in Charlie Ellis, Burton Malkiel, John Bogle, the old textbooks. The old one was Being Sharp, the new one is Bodie and Kane. I mean, there's all good places to go. But for my mind, and the one I am going to be using as an example of the traditional, conventional approach, is dear old David Swensen, the one who runs the Yale Foundation. In 2005, he wrote a book called Unconventional Success that basically started out to be a faster way for the public market for individual investors and small endowments to do what he did at Yale. And he found out, no. It turned out to be a book of don't try this at home, kids. That going back to the old simple approach worked. And in fact, he has a guest lecture on the internet in the Open Yale courses on financial markets. But in that book, he basically set out a base reference allocation. That base reference allocation was this in 2005. 30% U.S. Russell 3000, 20% in REITs, 15% in developed markets, 5% in emerging, 15% in TIPS, 15% in fixed income. That was what he considered the base reference portfolio. You can do something different, but you better have a reason to do it. Now, by the way, when I advise individuals or small endowments, that REIT TIPS is 35%. That's a lot. Now, he was very concerned about long-term unexpected inflation, and REITs, TIPS respond immediately. REITs respond in that 4 to 6 year period. Over 15 to 20 years, U.S. stocks respond quite well. So depending upon where else you're inflation protected or not, depends. For example, when I do advice, I tend to do less REITs, about 10%, and put an extra 5% in emerging markets and small cap stocks. But it's a matter of preference. His basic reference portfolio is a good place to start for anybody. Now, how has that done over the years? Well, of course, prior to 2005, before he wrote it, of course it did great. That's always wonderful. But this is how it's done since 2005 through 2008, 2009. This is a growth of $1 since it was published in the Swensen portfolio, then the Russell 3000, the Lehman Aggregate, EFA, HFOF are the hedge fund-to-fund index, HFR fund-to-fund. HFR XLGL is the hedge fund global. And you can see how that's done through one of the most remarkable periods of time in our investment lifestyles. And you can see he's beaten them all. That simple portfolio has beaten hedge funds, it's beaten EFA, it's beaten aggregate, it's beaten the Russell 3000. If you take that and just rebalance on some regular occasion. So it's done well, absolutely. Well, how has it done against himself, against his peers, against the sophisticated investors that are making $1 million a year during that same period of time? Well, you can tell there's a huge difference between that basic Swensen portfolio. And then at the other hand, you see where Yale is. And in the middle are the rest of the educational endowments. And you can see what's happening here is there's just a huge move away from public markets into private alternatives, into private real estate, into natural resources or commodities, into private equity, into hedge funds. And you can see a huge exposure and away from the public equity markets. So clearly, given the turmoil in the public markets, they must have done better. He might have done fine on his own, but of course against the fund. Well, This is the peer rankings. Now what this comes from the BNY Mellon Universe, June 30th, 2012, which is the last time you get all the endowments. We'll pick it up again in another a month or about 3 months by the time the numbers come in, going 1 year, 2 year, 3 year, 4 year, 5, 7, and 10, 236 funds in the endowment universe. The median is that median educational fund, how that did. The top are the returns that Swenson got with that simple portfolio, then that alternative I gave you, and the bottom returns are Yale's returns through last June 30. And as you can tell, for the last 5 years, Swenson beat Swenson. In fact, for the last 3 years, that simple portfolio was the top performer of all educational institutional endowments, including Yale. For the last 5 years, it's beaten almost everybody. And over the entire 7 to 10 year period, it's done quite well, top quartile. In fact, much, much better than the median person out there. So even if you are the most sophisticated investor in the world, you can be beaten by a nice simple portfolio over long periods of time, 3 to 5 years here. And I can tell you through this year so far, my guarantee is that the simple portfolio is beating Yale again, given the way the markets have gone this year, except maybe the last couple of days. This demonstrates something that you would see if you watched that lecture that Swenson did for Bob Schiller's class at Yale. And that is that there's an assumption that even if you believe, say you believe that more complex, sophisticated investing can get you more, people assume that if you can do well with simple. You might be able to do well if you're a top-notch, complex, sophisticated investor. But people have this assumption that it's a straight line up. That if you just keep adding complexity, you'll get better and better. No. What happens is this J-curve going down. That what happens at the start by adding complexity, you don't get better, you get worse. That it's only at the very end that if you're at the top of the game, you can pick the top quartile hedge funds, you can pick the top decile venture capital, you can reduce your transaction costs and not be carved up like sashimi by the high frequency traders. That there's a huge amount of things going on out there that the odds are against you when you first embark on that. And in fact, it may only be at the very end, only a very few can be complex and better. And as you can see, and I think Swenson is the best, even if you're the best, you can get beaten by the simple approach over prolonged periods of time. It's a matter of faith, not fact. I'm going to skip this one. So what are the basic investment principles that underlie the conventional approach, that underlie that simple Swenson approach, that underlie the lazy way of going about? Well, the way you go about doing, you start with a long-term time frame, 5 to 10 years at the most. You've got to be able to stick to your going. Use modern portfolio theory. Modern portfolio theory is still modern. Use 5 to 6 asset types, core index, and then have some big beliefs if you're going to play around the edges. Adjust for short-term wildness. If you have a problem, the standard rule of thumb is if you need money within 3 years, you shouldn't be investing in the markets. Cash is probably your only alternative if you have obligations coming due within 3 years. Control your leverage. Avoid the big mistake. Never make in order to get market returns, you need to be in the markets. The biggest mistake is getting out of the markets at the wrong time. And then after you have done that, got your base position in 5 to 6 asset types, then you add investments or change that if you have a clear need, if any. If you can't handle with the interim volatility of the markets, you may have to do something different. Many of the college endowments have real return needs of 8 or 9%. If that's the case, market returns of 5%, you got to go start rolling dice somewhere. But if you are a standard investor who market returns 3.5 to 5% real are good enough, there is no need to move away from that, because as soon as you start moving away, the odds start turning against you. Now, There are some basic assumptions that are made by this standard approach. There are no question. And there are 4 in particular. This takes you back to the 830 finance course in freshman year of college or wherever it may be. The assumptions of the conventional approach is that there are normal markets in the long term, that if you can wake up once every 5 to 10 years, that the return is generally related to risk, is linearly higher risk and higher return go hand in hand. And here we mean risk by volatility, because the other assumption is that broadly returns are coin-tossingly random, that famous bell-shaped curve, because that's what allows you to use things like volatility as your basic measure of risk. Diversification reduces risk and can add to return. But that only goes for the first 4 to 6 asset classes. And these assumptions hold for the longer term. These assumptions hold for 5 to 10 year rolling time frames. They don't hold year in, year out. They don't hold day to day. They don't hold month to month. Now, this is I'm going to show some graphs showing that these particular assumptions have held true. This is your standard risk or volatility along the x-axis, return going up the side, and you can see the ones with the higher volatility, small stocks, get more return in a somewhat linear fashion over the very long term. This shows that over rolling 5-year periods, that it is exactly how you would expect a coin-tossing system to behave. That after 5 years, if you can wake up once every 5 years, the blue is an actual experience from 1871. The red is what you would assume if it was a Gaussian coin-tossing random. And of course, that isn't a perfect bell-shaped curve because there's only a number of datas there. On the other hand, the actual experience is better than perfect. This is your standard chart as to how diversification works. There's 2 things that, whoa, I'm going to trip and give everybody, there's ones that softens return, but then there's also something called the free lunch of diversification. Now, for those of you who don't remember the example, your daddy leaves you suntan lotion Inc. This is a place that rains randomly half the time. You can't tell when it's coming. When it rains, you make 60%. When it's sunny, you make 60%. When it rains, you lose 40%. Or over the entire season, you lose 4%. Snidely Whiplash comes out and says, have I got a deal for you? Put half your money in my company. It's Umbrella Inc. When it's sunny, you lose 50%. But man, you make out like a bandit when it rains. You make 70%. You say, wait a minute. You know, that over the whole time, I'm losing 15%. And that's more volatile. Well, you just gave it up because the fact of the matter is if you put half your money in each, when it's sunny you make 5, and then put half your money in each when it rains, you make 15, you make 21% out of 2 losing companies simply by the fact of rebalancing. Now, obviously, well, first of all, what makes this happen? It means you can rebalance. You had to rebalance in the middle. You had to have assets that you could rebalance to and from. Now, by the way, this is an extreme example. The actual rebalancing impact on a reasonably diversified portfolio is about 40 basis points a year over 10 years, and not every year. When it trends, you lose by rebalancing. But there is, in order to get this is a free lunch diversification. In order to get that, you got to be able to rebalance. Now, I'm going to use another example. You don't want to over-diversify. These are numbers coming from the 1995 median estimates, risk return standard deviation correlations. I'm going to use this for two points. The first point is, after a few asset classes, the benefits of diversification start to disappear. Going from just stocks and cash to stocks and bonds, you gain some diversification volatility benefit. The middle one is your basic 65 stocks, 44% US, 21% EFA, 35% bonds. And then at that point, adding an asset class made no difference. The benefit was off on the 4th decimal point. So that benefit disappears. You get more benefit from going to the 4th to the 5th asset than you go from going from the 44th to the 45th. There's hardly anything. So after about 4 or 5 or 6 or 7, it doesn't make a difference. You're getting complication for no real reason. But, by the way, I used the 95. By the way, I put these together back in 95 for a different presentation for a different purpose. But what these were rebalancing to was to get yourself a 5% or a 4.9% real portfolio with 3 assets. And basically, given those assumptions back then, 4.9%, and you could get 11, if you did a 44%, it said if you're going to do a 44% U.S. stock, 21% EFA, 35% U.S. bonds, your basic 65, 35, you would expect a 5% real with an 11.61% standard deviation in 95. Now, remember, since then we've had the Asian crisis, we had long-term capital, we had the tech wreck, we had the worst market since the Great Depression. Huge volatility, of course. People said that era is past. Clearly, this way of looking at the world, underlying normal convention, was blown out of the water. It didn't work. And that's why you got to do something new and complicated. Well, it worked perfectly. At the top was what I just showed you. What was expected for a 44% U.S. equity, 21% EFA, 35% U.S. bonds was an 8.6% return, a 4.9% real return, 11.6% risk. The inflation assumption back then was 3.75%. Since 95, to April 30th, by the way, to the end of the month before last now, that portfolio, rebalanced monthly, would have given you an 8% return, but because inflation was so much lower, it gave you a 5.6% return above inflation, better than expected. And the risk, the volatility, was actually less than expected back in 1995. What people were expecting for volatility in 95 was more than we actually experienced on a portfolio level. Why is that? Given the fact that everybody assumes it's all so volatile now. The numbers we are using and have traditionally used in conventional investing always included the Great Depression. Always, and now have included the 1880s and 1890s and the panic in 1907. The old conventional assumptions actually do work, and work perfectly. So, what is the conventional investment position? You need an expected return, something to give you a return stream. You active management, to the extent you concentrate your portfolio, you start to give up some of that diversification benefit. And after fees and transaction costs, a negative sum game. You better have faith in what you're doing over the longer term. The free lunch of diversification requires liquidity in order to be able to rebalance. You need at least 5 to 10% in an asset class to make a difference. Well, that has consequences for your base position. That means you're not going to have more than 5 to 7 asset classes. You're not going to be using commodities or other after production because they don't give you an expected return. You might want to put it in for other reasons. But folks, if you can burn it, if you can eat it, or you can bury it, it doesn't give you a return. It may be worth more later on, but it ain't because it's generating, it's not an asset class. Private assets are discouraged because you can't rebalance to them. In a time of a crisis, you can't sell it and move it into something else. Hedge funds or opportunistic management are disfavored in this, and as is tactical asset allocation. You have a discipline of rebalancing, that's about it. That's your base position. Take additional action only if you're sure you have an advantage over the standard institutional investor or a clear need. Or if you might have special insights in the managers. You may, 3 to 5% real returns may not be enough. Standard volatility, like for some corporate earnings, may be difficult. Or you have a short-term time frame. This requires you to be able to suffer the slings and arrows of outrageous markets over a 4 to 5 year period. You don't panic, and it's kind of like I don't. Anybody remember Hitchhiker's Guide to the Galaxy? Yeah, remember what it said at the top of the actual Hitchhiker's Guide said at the first page? Don't panic. That requires you to keep on track and have faith in the conventional position. Now, that doesn't mean you also can't try to capture some illiquidity premiums. There are a few illiquidity premiums out there that are pretty well demonstrated over the longer term, but they're all long term. And Antti Ilmanen, he's now with AQR, has a book called Expected Returns. It's probably one of the better summaries of all of the academic literature. And there's an illiquidity, there's a leverage, there's a selling volatility, a small cap premium, a value premium, momentum premium, a carry premium. I also happen to think there's a minimum variance premium. But the problem with these is they're not as easy as the academic literature would say to do. They require you to keep with it. Value managers, you know how long it takes, how long they can be out of favor for a while. So it is another very long term, and it's problematic getting them. But so you can do a little bit like that, but keep to the conventional position. Now, what are the benefits of the conventional approach? It's simple. You're letting the markets do the work. It's transparent. You can tell what your portfolio is doing by simply reading the headlines. It's focused. You don't have that many moving parts. You don't need huge quantitative systems to figure out where your risks are. And it's cheap and easy. If you index, it's practically free. You can get this as an individual. You can get that basic Swenson portfolio for 12 basis points a year. So everything else. And it produces long-term returns better than or equal to alternative approaches. Well, what's the problem? Well, there's an old saying, there's 3 ways to make money in the markets. One is physically exhausting. You work harder than anybody else. I'm a state bureaucrat. I don't work harder than anybody else. It's mentally exhausting. You're smarter than anybody else. Clearly not the case. The third way is doing it this way, and that's emotionally exhausting. You need to wait 5 to 20 years for results. The assumptions that are underlying this approach do not work in the 1 to 4 year time frame. And I'll show you that in a second here. But as you could tell from 2008, diversification in the various types of equities doesn't work in the short term. All equities acted alike. Oh, there was only equity. In fact, Charles says that a lot. There's only 3 asset classes when you really come down to it in a crisis: equities, bonds, and cash. It's in between that you get that more diversification benefit. You've got to accept short-term roller coaster volatility. You got to depend on what's called equity risk and return. You need to abandon the quest for higher than market returns. So you will be very boring at cocktail parties. And in fact, it's biz boring. It's hard to do nothing rather than something. If CNBC covered my type of investing, this type of investing, all you'd get is a blank screen and the sound of crickets, because you're not doing anything on any particular period of time. Now, why doesn't it work in the short term? Well, here's the main reason. 2 obviously same phenomena going on. This is a Rorschach ink blot. You can see a lot of things in this. But what these actually are of, the top one is a seismograph of the Sumatran earthquake in 2004, as it was registered at the University of Pennsylvania. The bottom is the daily S&P price movements for a 10-year period, from 8-year period, 2002 to same phenomena. The shorter term time frame for market returns are not efficient or coin-tossingly random. This isn't, if you go back, you'll notice there's these long periods of quiet and then just huge amount. Those are your high peaks and fat tails. This is daily. This is the same type of information monthly, where the red bars are what you would expect for that time frame since 1926 to 2008. If it had been coin-tossingly random, the blue is what actually occurred. And you'll see 2 things. First of all, I want to bring the attention to the high peak, where the blue, that's longer trending, mildly positive returns, much longer than coin-tossing randomness would expect. These are, everybody's heard about the fat tails, but this high peak stuff is just as dangerous. Because what that means is people start, when they're reaching for nickel, this is nickel grabbing. And you're reaching for nickel, reaching for you, all of a sudden you're making more money. You have a huge, this is where you get huge Sharpe ratios. Sharpe ratios love this sort of nickel grabbing behavior, selling out of the money calls. But what happens is that type of behavior gets overwhelmed by these small fat tails at the end, because while these are not as numerous, they have a huge amount of the market action happens in those fat tail events. 2% of the months give you 10% of the market action. Big market moves up or down. 5% of the months gives 20%. 10% of the months gives 33% of the action. Because even though there's a lot of activity on this kind of grinding it out months, you're not making that much. And you can lose it all. You can get wiped out. So basically what happens is this is the shapes of the rolling distributions with high peaks, fat tails. The dotted part here is the normalized bell-shaped curve. You can see daily, like you saw with the earthquake, high peak, fat tail. Rolling 3 year, you still get a good high peak, fat tail. It takes about 6 years, rolling 6-year numbers, to start to see that sort of long-term normal randomness type of shape. And that's why you've got to be patient. That's why making moves, even on a 1 to 3 year time frame, you're still in that high-peaked, fat-tailed world, and you can get subject to that. Now, the reason I bring this up is a whole bunch of reasons to bring that up. That's why the conventional approach is so tough to stay with. And there's always an assumption, by the way. All the proofs out there are saying, oh, the markets are inefficient. Yes, because all the market data shows you that for 1 day, 1 month, 1 year, et cetera, the markets are inefficient. But there's an assumption that because markets are inefficient, therefore active management in and of itself is going to be a success. You can build a long-term program around doing very opportunistic active management. But there's a big problem. It isn't, because what they're rolling into is going into earthquake math. It may be more dangerous than a normal, milder coin-tossing world. And one of the reasons is the dangers of that high peak. Because people can fool themselves into thinking that it's my brilliance because I'm getting much better returns than normal randomness would say. Well, yeah, because you're in an environment where normal randomness isn't occurring. So, I am going, in my final 13 minutes, to go to hedge funds. Because the endowment model obviously had problems, illiquidity, headline risk, blow up. A normal conventional approach lost 16% in fiscal year 2009. The endowment model lost around 25. So I won't beat a dead horse because they're not coming back. But what you are seeing now is the advent of 2 and 20, fast money, hedge fund, options, doing all sorts of stuff. But there's a problem with opportunistic and alternative active management because on average, it's a losing proposition. Yes, picking the top quartile hedge fund, picking the top decile venture capital fund will make you money. But on average, the average institutional experience has not been pretty. The average public fund manager tends to lose to an index. The average private equity and VC manager tends to lose to the public markets. The average hedge fund manager loses to private equity and as you can see, it was a flat number. One of it is expensive. It's tough to get over the active management expense fees. Transaction costs, 2 and 20 vehicles, and if there is an opportunity, it has tended to be taken by the fees. There is a great line in one of the early drafts of a study a bunch of professors did for Norway about where they reviewed all the literature. And they said, yes, indeed, there is an illiquidity premium. It's about 3%. And it is true that the general partners are the best business people in the world. But their business isn't beating the markets. Their business is getting a fee. And the reason is that 3% premium, they took 4% on average. Because what happened is the losers don't pay you back. It's an asymmetric payoff. So, and overall, because of all these things, there's a significantly inferior risk-adjusted returns. You have to adjust the PE returns. They have a small cap bias. Most PE is small cap, and they get a small cap bias. There's extra leverage in PE, and there's a survivor bias in PE and the databases. You got to adjust hedge funds for styles, fees, leverage, and survivor. There's some good books out there that they overstate a good case, by the way, and I won't go through it here. But if you are going to move into a predominantly actively managed fund with a lot of different things out there, you got to realize that in general, the odds are 3 to 1 against you. And if you do have a bias, like a value bias, you better be willing to stick with it for 5 to 10 years, because those things can be out of favor for 6 or 7 years at a time. And as some of you all probably remember, the end of the 90s with the death of value investing was clearly proved to be dead, and then came roaring back. And people don't have the staying power. So now, I'll end up with some specific hedge fund observations. One of the things that is a little known thing in Dodd-Frank is it requires that every presentation, finance presentation, besides saying for internal use only, has to have at least one Yogi Berra or Warren Buffett or Winston Churchill quote. I'm going to take care of them with Yogi Berra quotes with regard to hedge funds. And one of them is half the lies they tell me aren't true. You heard, particularly in 2005, the mid-2000s, that hedge funds would give you good returns at low standard deviation, that they were better and safer in rough times, and they were good diversifiers for the portfolio. They had low correlations with the standard asset types. The claim was they gave you equity returns with bond-like risk. Well, what I want to show you is what they've given you is less than bond returns with equity-like risk. They said, we're going to give you absolute returns. Well, what they forgot to tell you was that absolute bar could be around a negative number, worse than standard portfolios. And they said as a good diversifier that it decreased portfolio dependence on market risk. But what they actually did was they basically shorted large cap stocks and went into other things, oftentimes cash. And that, for many of us, we do in our portfolios. They're doubling down on what we were doing in our portfolio otherwise. As Yogi Berra said, slump, I ain't a slump, I just ain't hitting. This is between 1993 and 2012, that Swenson portfolio I showed you earlier. Growth of $1 would be through June 30, 2012 would have quintupled your money. By the way, Swenson does have tips. I put in aggregates up to 1997, aggregate bonds to substitute for the tips. U.S. stocks would give you 463. U.S. bonds would give you 336. IFA had a bad, how many years was that? Almost 20 years. Gave you $3. Hedge funds, 320. Below bonds, with pretty close to equity volatility. So first of all, that ability to give you good equity returns. Now, a standard, diversified, simple portfolio still beats them all over the very long term. Well, how about 2005? Because that's when the hedge fund movement really hit its stride. We're here to protect you against bad markets like you just had in 2001 to 2003. We're going to give you absolute returns, and that's when everybody started going in. That's when Swenson wrote his book, so that's why the data's there. Again, comparison. Hedge funds have been dead money. The hedge fund of funds, clearly, $1.25. The hedge fund global, those are individual hedge funds weighted according to the amount of institutional capital in them. That's the index that the HFR, hedge fund research, gives out daily. It's been dead money. And you can see it isn't just the type of hedge fund. It's the fund of funds. This is from June 1. This is through June 30, 2012. All macro hedge funds haven't done well. Global hedge funds haven't done well. Absolute returns lost you absolute money. Equity hedge funds, they just haven't worked. Now, admittedly, this is the median experience. There are hedge funds at the top of the class that do very well, but you got to be able to pick them. You've got to be able to say, I can pick those types of managers. And from my experience, all of these guys are smart, they're intelligent, they're able, and that just gets them in the game. I mean, over all my years I've been doing this, I figure I can pick the pro from the amateur. I can pick the good from the bad. I can't pick the great from the good, particularly in advance. It's a different skill level. And if you got it, go for it. Now, this is this idea that they diversify. But what they're actually doing is taking money away from the S&P 500. This is excess returns to a 55% Russell 3000, 15% EFA, 30% Lehman aggregate, sorry my age, Barclays aggregate fixed income portfolio. And the green shows when the S&P 500 beats that basic diversified portfolio. The red shows when the HFR fund of funds beat or add to returns to that portfolio. And you can see that yes, from 99 to 2003, hedge funds added to your basic three asset portfolio. From 2007 to 2009, it added. But it was exactly at the times when the S&P 500 wasn't working as a capital market. And basically, if you have difficulty with your S&P 500 exposure, it's probably cheaper simply to short or reduce your S&P 500 exposure directly than it is to go into hedge funds, because over time, the excess return to your basic portfolio has been terrible with hedge funds. So, a lot of what I see us doing today is what I would call deja vu all over again. You're starting to see a lot of old failed approaches under new wrappings. The number of times I've seen tactical asset allocation come back over the last 20 years, that's got to be at least 4. It reminds me, it's like taking underwear you used to buy at J.C. Penney's and then repackaging it and selling it through Victoria's Secret. It's just repackaged. There again is this idea that there are managers with speculative genius who may only be capturing the moment of the time. Because remember, if you have a high peak, there are some people who are going to look good. You're going to get new untested approaches with a theory but no sustained track record. Investments that are at the tail end or fads all of a sudden become seen as being mainstream. And I think one of the biggest issues is that the industry on all sides is incented to support complexity. 2 and 20 fees. You can see with the hedge funds why they're marketing these things. They get into it's one of the most lucrative. I thought we'd put that bed back in the 1980s when we got rid of that in real estate, and it kept coming back as opportunistic funds. So the 2 and 20 fee is a killer. Consultants have a reason to do complexity, to do outside CIO work, to advancing, because to simply sit there and say, put it in 5 asset classes and call me in a decade doesn't do anything. People on my side of the industry have a huge incentive to do this. If you're a board member, ever go to lunch with a passive manager, it's boring. So I mean, you want to be able to have someone to talk to. But for CIOs and staff, you get to reach for a brass ring. You get to try to go for one of those $1 million endowment fund type things. There's a real incentive to go there. And of course, the media needs to fill their space daily. So I think you're going to continue to see these sorts of things going on, and arguments continue to be advanced. But the facts have shown that conventional investing has done very well, that for the vast majority of people who simply want reasonable market returns with about 3 to 5% above inflation and don't want to lose it all, that they can win by not losing. It is a very, very good, solid approach, and for the vast majority of individual foundations, endowments, and others, it works wonderfully, has worked for the last 30 or 40 years, and my guess is it'll work wonderfully for the next 30 or 40. So that's the end of the presentation. And